Hello, everyone, and a very warm welcome to this event organized by the International Finance Forum. I'm Jerry Rice, and our topic today is cross-border payments, how to make them more efficient, less costly, in essence, to modernize the system and bring it into the 21st century in some ways. There's a recent paper from the Bretton Woods Committee entitled A Dual Strategy to Transform Cross-Border Payments, and it provides very useful context for our discussion. And that paper, if you haven't already seen it, is easily available on the website of the Bretton Woods Committee. Just type in brettonwoodscommittee.org, and it's quite prominent there on the homepage of the Bretton Woods Committee. This paper that we're talking about today is actually the second in a series of papers from the Multilateral Reform Working Group of the Bretton Woods Committee. The first paper, which was released last year, was on strengthening multilateral institutions to tackle the crisis of the global commons, with a particular focus on climate. Then there's the paper we're discussing today. So that's the second paper in the series, which in some ways deals with another aspect of the commons, which is cross-border payments. And then there will be a third paper forthcoming that will address the governance of digital public infrastructure and data. So the Bretton Woods Committee really leading here in a number of these very important areas with some innovative research and analysis. And we're very fortunate to have with us two of the leading experts on these topics, both of whom have been very involved in leading this body of work and actually been involved in writing the papers as well. So let me briefly introduce our speakers today. First is Bill Dudley, the principal author of the paper on cross-border payments. I won't go through Bill's extensive CV, but to note that he is one of the most respected economists in the world today. And amongst other positions, Bill has served as president of the Federal Reserve Bank of New York, as vice chairman of the Federal Open Market Committee. Bill was also a board member of the Bank for International Settlements, and he chaired the BIS Committee on Payment and Settlement Systems. So very appropriate again for our discussion today. Bill is a senior research scholar at Princeton, and he's currently the chair of the Bretton Woods Committee. Bill will be in discussion today with Siddharth Tiwari, who, like Bill, is very well known to many of us. And again, without going through Siddharth's extensive CV, I would highlight that he has served as head of the Office for Asia in Hong Kong for the Bank for International Settlements. Siddharth has been executive secretary to the G20 Eminent Persons Group in Singapore, and has held numerous senior management positions at the International Monetary Fund, including as Director of Strategy, Policy and Review. He was also secretary of the IMF, served as Chief of Staff to the Managing Director, and other senior positions. Siddharth's areas of expertise include the international financial system, the IMF, the G7, the G20, technology and finance, digital public infrastructure, and data governance. He has extensive experience working in BRICS economies, South and Southeast Asia, as well as Africa. I'll just mention most recently, Siddharth has been advising the Indian government in their role as president of the G20. Let me leave it there on their CVs. You can read all about them on Wikipedia. They're both there. So with great thanks to Bill and Siddharth for being with us for this conversation on cross-border payments. We'll try to leave some time for any questions that you might have if you're listening into this, watching this live today. And you can post them. You'll see a Q&A little function, little box on the screen if you click on the screen. And you can put your question there, or you can just put your name there and say you'd like to ask the question, and we'll try to do that toward the end of the event. Okay, that's enough from me. Over to our star discussants today. And Siddharth, I'm going to hand it over to you at this point.
Thank you, Jerry, and a very good morning to our audience in the Americas, afternoon to audiences in Europe, and I know it's late evening in China. It's 9 p.m. already. So good evening to our friends in the Far East. It's an honor to have Bill Dudley speak to us on this topic. And in the conversation today, I'm going to try and focus on the main messages of the papers for the audience. And beforehand, this paper was shared extensively in Asia. So we have a set of questions already from several media outlets. And so that we have a cohesive discussion, I will work these questions then into the conversation as we go forward. So as Jerry mentioned, this is the second group. It's timely that the firm Ta Kung Pao in Hong Kong, who asked that, Bill, if you would introduce the main pieces of the Multilateral Reform Working Group before we delve into the paper itself.
So the thesis of the paper, the speed, lowering the cost, and it's more inclusive, would be really useful from an economic development perspective, especially in countries, for example, in Africa, where the payments regime is actually becoming in some ways less efficient because correspondent banks that would provide these cross-border payment services are often pulling back because of worries about anti-money laundering and terrorist financing risk, and the fines that might accompany violations of those policies. So in a number of areas of the world, things are going backwards as opposed to forwards. The second thing I think we have to say here is just that the cost and speed of the current regime is not very remarkable, not very impressive. If you make a cross-border payments, international payments today, say your remittance is sending money home to your family in your home country, typically it costs 5 to 6% or more of the cost of the amount you're remitting, and oftentimes it takes several days for the transaction to go through. So the G20 countries recognize this problem, and they've been working on it for some time. And in 2020, they announced a series of targets and objectives to dramatically increase the speed and reduce the cost for cross-border payments, and basically tasked the Financial Stability Board and the Committee on Payments and Market Infrastructures at the BIS to essentially set out a roadmap for how this could be taken forward. And the Financial Stability Board and the Committee on Payments and Market Infrastructures have done a lot of great work in terms of outlining what needs to be done to move this forward. But the progress still, I think, is, to be honest, has been relatively slow. And that's in part because of where we're starting from.
So that's a good segue into the next question, which is, as you mentioned, that for many decades now, the official sector has been trying to make cross-border payments faster, cheaper, safer, and the amounts are large. Remittances are over $1 trillion annually, so there's money to be made here. At the same time, technology has moved rapidly, a quantum leap, but somehow the payment system hasn't adjusted to the advances in technology. The next question, also from CNBC, is that when you look at the progress made, what do you think is the single biggest obstacle that is currently faced by the official community?
I think there are two problems, and they're quite different. One problem is the fact that to have a global system that's interlinked for cross-border payments that are near instantaneous and low cost, first you need national instant payment systems that are viable in their own countries. And we have examples of such regimes that are quite successful. For example, in Brazil and India, in Southeast Asia, a lot of countries have very effective national payments regimes where people actually use them extensively. But in some of the key regions, we're nowhere. The United States is probably the leading example. There's two instant payment systems in the United States, FedNow and RTP that's offered by the New York Clearinghouse. And I looked just recently, and they have well less than 1% of retail payments in the United States are executed through these rails. So if you don't have a successful national regime, the idea of linking this not successful national regime into an international regime, that's much benefit. International payments, the leg of the foreign exchange transactions. So if the U.S. isn't successful and the U.S. isn't interlinked, it's really sort of quite a challenging task to get to a global regime. Now, there is lots of work being done. And, I think in Southeast Asia, we're probably making the greatest advances through the BIS's Project Nexus, where you're trying to link together Singapore, Thailand, Indonesia, Philippines, together into a regional regime. But obviously, that only gets you a small portion of the way to a global regime. So I think, I think Project Nexus is a really good idea, and I think it's really good that the BIS has taken this on, working through the BIS Innovation Hub. And I think that they have a good governance model for how this might work. But even if we get that done, there's still the problem of what's gonna happen in the U.S. And the Europeans are, they're doing better than the United States, but they're not that far ahead. What we see in countries that are successful in developing national payments systems that they're viable there's really two attributes. Number one, there needs to be some sort of mandate forcing existing payment providers to offer the service on attractive terms, and we don't have that in the United States. We do have that in places like Brazil and India, and it's interesting that just recently Europe has decided that they're going to require mandates to use their own instant payments regime. And the second thing you need to do is you need to have a reason for people to find this as attractive means of payments. One of the problems that we have in the United States is everyone's very comfortable with using credit cards and debit cards and Venmo and PayPal to make their payments. And so there's no reason to shift to a new regime. Even in China, where you have the ECNY, lots of people have set up accounts for the ECNY, but if you look at who's really dominant in retail payments in China, it's Alipay and WeChat Pay. So it's also hard to migrate people away from something that they think is actually already working for them well domestically.
So you've already veered into the next part of the discussion. In the paper, you concentrate on two alternative paths to make cross-border payments faster, cheaper, and safer. Broadly speaking, it's the first path is digitalization, and that's Project Nexus that you just talked about. And the second part is the path of tokenization. China Business Network is asking if you would explain the essential differences between these two parts. And it seems like there's a fork in the road in these two parts, the way the paper is presented in.
Yeah, I mean, these are very different paths. The knitting national payment systems together is really sort of incremental. it's really agreeing on common standards, common governance, common rules on how to deal with any money laundering and terrorist financing risks and things of that sort. But at the margin, it's really more incremental as opposed to earth shattering, and it's using sort of existing technologies as opposed to moving to a sort of new technological regime. So it's more practical in the short run, but it's also much, much less ambitious in terms of what it actually can do. Even if it's wholly successful, all it can do is make cross-border payments more efficient and faster. The Finternet conception is much, much broader, because this is about tokenization of all types of financial assets, not just to be used for payments, but also for securities transactions, for property, could be used for art. So it's but the ability of taking any financial asset and basically turning it into a token, where the token shows here is tied to that financial asset, but also contains all the ownership information associated with who actually owns that asset. And a tokenized asset also, as you know, has the potential of having much more functionality, because you can embed in that tokenized asset smart contracts that can be triggered by various events being satisfied in the world. So if bond yields go above a certain level, then certain in terms of the token action is the idea of the Finternet assets, and you would settle every asset, but you need to have a series of unified ledgers, and you don't also want to interact with each other. But this is way beyond in the United States legislation on stablecoins, which is sort of provide a governance framework for simple tokenized assets. It's a long leap to actually get to the Finternet. So my view is that we really should be working on both of these channels, because the first channel on knitting national payment systems together is very doable, very achievable, and it's going to happen. I think it can happen over a decade, while the Finternet is probably a multiple decade project, where the go live is probably 2035, 2040. As opposed to into the near term. So it's certainly not going to allow the G20 to fulfill their objectives in terms of instant payments. But what we need to do is basically set standards and rules for both of these regimes, and then essentially get out of the way and let the technologists run the race and see which regime is actually more viable over the long run. We probably also want to be at least aware of the transition path from one to the other, and try to, as we're developing our global payments regime, to make it so that one can imagine how it could transition into a Finternet, as opposed to be sort of a dead end where you'd have to leapfrog to a whole new system.
So just staying with the first one, what's clear is that instant cross-border payments won't work if the national payment regime is not instant. So you can't have something instant cross-border and then it takes 2 or 3 days to settle. And I'll tell you a small anecdote. When I was in Hong Kong, this was about 5 years back, if I gave my neighbor a check, it would take them longer to cash it than if I walked down to their bank and deposited it. And this was Hong Kong, which was, on the edge of, and this was 5-6 years back, on the edge of technology. And of course, today it's instant. It's one of the best payment system in the world. So I think a question that emerges again and again is that why is it so difficult to operate a system 24/7, 365 instantly, almost costlessly, and something that's big tech and fintech friendly, so that you don't end up in a situation like China where there are tensions between the two sectors. And the system settling within the regulatory framework inside the central bank. There are a few examples of this, but I was looking last night, and I think there are 75 countries out of 195 that have instant payment systems. And as you said, the US is not there. China is lagging. Europe maybe will join in the next few years. Is that a major problem for the global system to take off, or will we need to essentially wait for these two large regions of payments areas to join a global system?
Well, I mean, I think the benefits of a global system go up, sort of exponentially as more and more people join that regime. So if you have a system in Asia that works well among a small group of Asian countries, that's good, but that's not a global regime. So you can think about it. Every time someone joins, not only does that country that joins get the benefit, but everyone else who's already linked into that system already gets a benefit, because now they can do business with that country. And obviously, the U.S. being the biggest economy in the world and probably the most important economy in the world from a financial perspective in terms of the U.S. dollar, not having the U.S. involved, I think it limits how far we can go with this regime. If that doesn't get enough attention itself in terms of their own operating hours, there are many central banks around the world that are not open on a 24-hour, 7 days a week basis. And if you can't settle in central bank money on a 24-hour, 7 days a week basis, that you have a residual settlement risk. And this really makes you vulnerable to fraud. Because between Friday evening and Monday morning, if the payments have been transacted and the money has left the banking system, and there's and you haven't really settled to the central bank, there's an exposure there that you need to worry about. So I think part of this process needs also to be to get central banks to agree that we need to develop 24/7 real-time gross settlement systems. I think that's an important part of the story. And central banks are moving in that direction, but very slowly. And I think one of the challenges here is that the central banks of the world are just not on the technological frontier in terms of their ability to, leapfrog to new technologies. And I think that you really do want to have a modern technology based on APIs, because that also allows interoperability. I mean, one of the challenges here is how do you actually link all these regimes together? And that's why Project Nexus, was very much in the notion of the hub and spoke system. If you have a hub, if I have to link to 75 different countries, that's a huge setup burden. But if I can just link to one central hub, then I only have to manage that connection one time. And so that's why I think the Project Nexus model is the right model for how you would do that. But even there's lots of work to be done, because at the end of the day, whatever you have as that central hub, it's got to sit somewhere. It's got to sit in a particular country. Other countries have to be comfortable with how that country is going to run that system. And there have to be common rules agreed upon on terms of things on governance, about what happens when something goes wrong. How do you settle problems? And that requires trust. I mean, I think that's the key for any successful payments regime, is you need to have trust that the regime is going to work as desired. And it takes, I mean, I think, if you look at the foreign exchange area, 1974, Herstatt failed and created huge foreign exchange settlement risk. It took 27 years for the continuous linked settlement regime to be set up to handle foreign exchange risk. And that was set up, CLS Bank was finally established in the United States. So, this is not a rapid process of getting lots of countries to agree on the governance rules, and then how do you actually operate this regime. I think, in the defense of the BIS and Project Nexus, I think they have a really well thought through governance model of how this would work.
Right.
But until it's actually up and running and successful, there'll be some skepticism.
Yeah. So two sets of questions emerge from this. One, what you said initially was that the US people are pretty comfortable using cards. And so the pressure for change could come from two directions. One could be from the consumers who, if they saw differential pricing for products through instant payment system vis-a-vis credit cards, they would make that choice. And we don't see that happening. And the second, what you also mentioned, as the settlement goes from T+2 to T+0, several of these risks do not materialize or are minimized. And that pressure could come from the business side. As you see it, where's the pressure going to come from for change?
Well, I think the people that are, most disadvantaged by the current payment regime in the United States, for example, the credit card regime, are basically retailers who pay
Right.
2 to 3% interchange fee for the privilege of offering the card as a payments mediums, and low-income households who basically pay 20, 25, 30% interest rate on their cards. Higher income households think this is a very great regime because they don't perceive that they're paying for the interchange fees that the retailers bear. They get float on their credit card payments. They get reward points on their credit cards. And so from their perspective, this regime looks really, really good. So I think the first thing you need to do is have more transparency so consumers see that they're actually paying for this retail merchant interchange fee. And if they start to see that cost and can see that they can avoid that cost by using a different payments rails, then maybe you can actually make some progress here. But I think the fact that a regime is well entrenched is a huge problem. I mean, if you look at what happened in Brazil, Brazil made the leap very, very quickly. And the reason why they made the leap very, very quickly was that the existing payments rails were terrible. Merchants, when they did credit transactions, they wouldn't get paid for many, many weeks, and so they were very amenable to switching. So you need to create a coalition of those who actually want to, move to the different regime. So I mean, there's a lot of sort of what economists would call path dependency here. You can get into sort of a bad place, and then it's very hard to figure out how to work your way out of that place, given that the incentives that are in place. I mean, another advantage of credit cards is the fact that if something goes bad, you can go to your bank, and the bank will, reverse the credit card transaction if there was some sort of fraud involved. And one of the issues, obviously, with instant payments is, well, those are going to be sort of irreversible transactions, and so people are like, well, what do I really want to do something where I can't claw back the money if there was some fraud involved? So I think it's going to be challenging, but mandates can help. And I think it's going to be very interesting to see what happens in Europe, because just in the past year, the Europeans have basically said, we're going to require banks to offer instant payments access on the same or better terms as existing payment media. And it'll be interesting to see if those mandates actually do move the needle in terms of use of instant payments in Europe.
Yeah. So what you mentioned level I had to make was resolution system and getting it working within the day so that they began to mimic what the cards would be doing, and they made some progress on it. They're from two media outlets, which are large CCTV in China and Shaishan Media. I think the two sets of questions are and you touched upon them a little bit, the challenges in connecting these systems, and whether Project Nexus is the only way forward. Is it ambitious enough? Because this has been going on for decades now. And whether there are other alternatives, or is this the only way to go?
Well, there are probably other ways, but I think Project Nexus is the best mousetrap out there. And obviously, if Project Nexus, once it gets up and running and demonstrates their proof of concept in terms of its operations, then that'll create incentives for other countries to join as well. And I think it'll be very interesting to see what like India does, for example. You know, and once you start to add more and more people to the Project Nexus, you know, grouping, then the functionality of that regime goes up pretty dramatically in terms of where you can send payments to. And so, you know, it's sort of like a virtuous circle. More people join, the network becomes more valuable, which incents other people to take the steps to join the network. And I think that's really the theory of the case, is get something running in Asia, then get other people to join once it's up and running. And then people might start to join, you know, like what, you know, the question could be like to the politicians, like, well, why aren't we hooked into Project Nexus? Because we see all these benefits. And so I think that's probably the most viable approach for Run to the Finternet be used for cross-border payments, and stable coins are used today for cross-border payments, you know, in the crypto community. And basically you can actually make a transaction around the world in, you know, in a stable coin, and then you have to find a way to then convert that stable coin back into the fiat currency of the country that you sent the money to. So that's already feasible technologically. I think the issue there is really more about how do you manage all the AML, anti-terrorist financing types of risk associated with that. That's number one. And number two, we had to define what a stable coin is. For example, in the US, we haven't really decided what it is. Is it a security to be regulated by the Securities Exchange Commission? Or is it, you know, a de facto kind of commodity, a currency? You know, the US, I think, really needs to take a big step forward in clarifying what a stable coin is and how it's going to be regulated and governed. And the reason why I'm picking on the US here is because most stable coins are denominated in dollars. I mean, I think 90-something percent, you know, high 90% of all stable coins are denominated in dollars. But that's another path forward that, you know, it's in the direction of the Finternet, which is a much broader conception, but it's, you know, you can argue that that's probably the easiest use case of a Finternet type concept that could actually be implemented in the next, you know, 10 or 15 years. But first we need to clarify what a stable coin is, figure out, you know, have rules on how it's backed. You want a stable coin that you are absolutely 100% confident that it'll always be redeemed at par. And that requires, you know, basically rules in terms of the asset backing. And then you need a means to verifying that asset backing in real time. You know, it's not enough to say, well, yes, we have plenty of assets set away to back our stable coin, and we'll send you the audited results in 3 months. So you need something that where people really are confident that it will always be bulletproof. And stable coins also have created their own set of issues in terms of, you know, one, dollarization of economies. Like let's imagine a small country. People thought, gee, these dollar stable coins were really great. Let's use them rather than our home country currency. So you have that issue. You also have the issues in stable coins about, you know, potential flight into stable coins or out of stable coins into other financial assets, and how do you manage that kind of that kind of liquidity risk. So, you know, stable coins are, you know, it's another viable pathway that falls short of the Finternet, but there's a lot of work to be done on that front. And the Bretton Committee, we're going to have a paper coming out on stable coins, you know, any day now. It's at the copy editor.
Right. So moving on in the tokenization space, and you had mentioned earlier, it allows a whole lot of opportunities in terms of embedding smart contracts into this and having instant exchange. And it's tokenization is more widespread. And for example, land titles could be tokenized and takes away what consumers pay on insurance. Or if I look at some countries in Asia, the courts are backed up 10 to 12 years. 90% of the cases are differences in valuation of some transaction. And so there's massive social benefits from tokenization if it can be implemented in in the way we imagine it would be. And crypto world has a question here, uh, which which is, as you look into the future, what would a world of tokenization and smart contracts look like?
Well,
How would this?
I think the most interesting question here is really a number of important points need to be made about is this taking place on the blockchain, or is it some
Right.
different form of unified ledger? Number two, if it is taking place on blockchain, is it permissionless or is it permissioned? You talk to people in the crypto community, they want it to be very definitely permissionless. But
Right.
the issue with permissionless blockchains is, okay, who do I go to when something goes wrong? Who do I go to ensure operational resiliency? Who do I go to make sure that this is going to work? 99.99999% of the time. So I think there's some pretty interesting governance issues in terms of these choices, in terms of what this unified ledger looks like. And I think the Finernet paper doesn't really get very deeply into those notions of choices. I think the unified ledger concept in the Finernet paper is that it's somehow permissioned, and it's somehow by some centralized body, but still very open in the world between the crypto community, who sort of envision something much more like the internet, where the internet is sort of owned and operated by everyone and owned and operated by no one. So,
You're right.
so I think the crypto community points to the internet as an example of how something very distributed can actually be managed and work successfully, even without sort of a centralized authority. So I think that debate hasn't been settled.
Right.
And that's a pretty important fork in the road and determining which way that the internet kind of model evolves.
And then there's the second debate that is going on, where Europe and the United States have taken a different direction, and that's on central bank digital currency, where Europe seems much more open to moving in that direction. Whereas I think in January, President Trump signed the executive order prohibiting the Fed from developing a central bank digital currency. I wasn't quite clear whether it was only retail and wholesale, and that sort of left it vague. I think a lot of people in this field are hoping it's only retail. So I guess the question is, if we look at sort of the three countries, areas that we talked about before, China, Europe, and United States, that are where instant payments are lagging. China's, very early has been experimenting with the central bank digital currency. Europe is forcefully moving in that direction. The US has hit a pause. Can a global system be established in this situation, given what you said right in the beginning, that the US dollar is on one side of 85 to 88% of Forex transactions?
Yeah. So I'm of the view that you don't necessarily have to have a central bank digital currency to make all this work. I think if you have a stable coin that's backed by central bank reserves that settles in central bank money, de facto, that gives you the same functionality of a central bank digital currency. And so I think that's the way that maybe the US might go. Even before the Trump administration, central bank digital currency in the United States was very controversial, so much so that Chairman Powell of the Federal Reserve said that the Federal Reserve would not pursue any initiatives on central bank digital currencies without an express act of Congress. So it's not really just the Trump administration. There's a little bit more of a reluctance to have the central bank sort of be as deep into the household balance sheet as compared to maybe some other countries. But I think that a stable coin regime can functionally do the same thing as a central bank digital currency if it's properly structured. Again, though, there are these issues about run risk, and once you have these very, very safe assets denominated in particular currencies, you do have to wonder what happens in a time of crisis, and does the money move very aggressively into those safe assets. My personal opinion that is, if you have a stable coin that serves sort of as the functional equivalent of a central bank digital currency, I think you probably don't want to have it be interest paying, because if it's interest paying, and then it becomes a financial asset, it becomes an investment asset. If it's non-interest bearing, then it's really just a payments medium. And if it's a payments medium, it's going to be there's not going to be that much of stable coins outstanding, and the turnover rate is going to be pretty high. If you start to allow stable coins that actually pay interest, boy, you can imagine, disintermediation out of the banking system into the stable coin, all sorts of financial stability risks that could arise from that. So I think you have to be pretty cautious about how that's structured.
So this takes me to a little bit outside the focus of the paper and getting into, in recent years, I think there's been a bit of the sense that currencies often get weaponized, sanction regimes, isolate countries, rightly or wrongly. I don't want to get there. It's a big discussion, and the answers change whom you ask. So with this as background, I was a bit surprised that at the BRICS summit in last October, there was a talk of constructing a payment system or regime. I think they didn't elaborate it too much, but they were trying to model it after the Enbridge project at the BIS, trying to see if tokenized currencies within certain countries could get off the ground. Is that feasible? And if it is, what are the risks of going down that route?
Well, I mean, the obvious risk is you start to fracture the global regime, and it's pretty hard to get to a global international payments regime if you have two separate, distinct payments systems. I think the BRICS countries are pursuing this in part because of the fact that the U.S. has used sanctions against countries that have engaged in policies that the U.S. views as inappropriate, like the Russian invasion of the Ukraine. And so countries who are not friendly to the U.S., who worry about the potential for future sanctions, are trying to figure out how can they disengage from a dollar-based payments regime so they can avoid these kind of sanction risks. So that's really, I think, the motivation for setting up a different regime, is really to insulate you from sanctions that the U.S. might impose if you do something that the U.S. judges as inappropriate. So I think the issue here is really, how does the U.S. use sanctions, and what are the consequences of using sanctions in terms of providing an impetus for countries to figure out how can they avoid that risk. So it's not clear to me that the U.S. could solve this problem very quickly by saying we're not going to use sanctions in the same way, or we're going to consider when we use the sanctions what the consequences are for the U.S. dollar as the dominant reserve currency. In some ways, the U.S. is, by taking these actions, is creating incentives for people to look elsewhere. Now, do I think the dollar's role as a reserve currency is going to change anytime soon? No, I don't, because the U.S. dollar has a number of really favorable attributes. We have a well-established rule of law. We have convertibility. You don't have to worry about capital controls. You can always convert your dollars into other assets. And the U.S. has very deep liquid capital markets, and the U.S. economy is the biggest economy in the world. So to move, this comes back to our earlier conversation about, what's the dominant payments medium. It tends to stay the dominant payment medium unless something happens to create different set of incentive people to move. So I think that the dollar is the global reserve currency will basically continue as long as the U.S. doesn't sort of mess it up.
Yeah, the other talk in that summit was whether BRICS countries could move in the direction of raising money through BRICS bonds and the rest. And the obvious danger there is if one of the component currencies is under sanction, the basket would be likely under sanctions. And that's not viable
Well, I
way
think that,
moving forward.
I also think, the problem is that, well, conceptually, this idea of an alternate, regime to the U.S. dollar you can see how it, might sound attractive to some countries, but these countries also have different objectives themselves relative to each other. And so I think the figuring out how this big lift given each individual country. So, but going from the interest to actually having something that's well functioning with, and the sturdiness of the individual economies differs too, and the resources of the individual countries differ. So I just feel like there's going to be a lot of, the devil's going to be in the details. The more you delve into how you actually would do this, I think it's going to get harder and harder rather than easier and easier.
So coming back to the paper, towards the end of the latter half on the paper, you have a series of recommendations on how the international community can take this forward. And Xinhua News and Yisai Global are asking two sets of questions. One, what do you see the role of multilateral institutions in promoting some of the reforms discussed in the paper? And second, do you see, and you touched upon it a little bit, do you see that the international community is working in a way that the transition from digital would be easier than falling off a cliff?
Right now, I think there's a lot of work to be done. Look, I think the multilateral institutions can play a very important role in terms of setting, sort of standards and, creating a notion of what good governance looks like. I feel like there was a lessons learned from the great financial crisis in terms of financial market infrastructures. As you remember, we had over-the-counter derivatives that had lots of obligations firm to firm, and when Lehman Brothers failed, that turned out to be a horrible mess. And in the aftermath of the great financial crisis, the G20 countries said, well, we need to clear all these over-the-counter derivatives through central clearinghouses. And then the question is, well, how do you make these central clearinghouses bulletproof? And the Committee on Payment and Settlement Systems, which is the precursor to the CPMI that exists today, and IOSCO basically developed the principles for financial market infrastructure, which said this is what you need to be able to do in terms of outcomes. It didn't tell the countries how to achieve those outcomes, but it created a standard of what good looks like. And I think we need to do the same thing in the international payment space. We need to have a set of standards of what good looks like. And then you give it to the individual countries, and they can figure out, given their institutional setup, what players are dominant in their regime, how best to achieve those standards. And then you can use, like the IMF can come in and evaluate whether they're actually doing what they are supposed to be doing. So the IMF, in the principle for financial market infrastructures, came in and did FSOPs, evaluations of whether the countries were doing what they want to do and providing technical assistance. So I think the international community, especially the BIS and the Financial Stability Board, they can play a really good role in sort of getting agreement across a large number of countries of this is what we want the outcome to look like. And then once you have that framework of what the outlook, what you need to achieve, then you can sort of delegate to the individual country, well, how are you going to actually go and achieve that? And I think the PFMI for OTC derivatives has worked extraordinarily well. I mean, I was worried about the financial market utilities putting all the eggs in one basket, but those eggs have been well taken care of by financial market utilities over the last decade.
True. And so in this, just to broaden the scope here a little bit, one could think of the IMF in a surveillance function, being able to benchmark countries, if that's the word to be used, once as you said, the standards of what good looks like is developed. And then the World Bank and the regional development banks and the philanthropies could help in capacity development and putting the tools in. And since these institutions talk, it could be done in a cohesive manner that the private sector would be part of it, and so the whole would be more than the sum of its parts, which I guess is the central thesis of the multilateral reform working group.
No, absolutely. Absolutely. And I mean, I think Africa is a great case in point. I mean, Africa is a continent with many, many countries. Each country doesn't have that much capacity to be the leader to pull the African continent together. But if you did have a African integrated payments regime, hugely beneficial for Africa, because it would basically reduce the working capital needs of businesses. It would lead to greater economic integration across Africa. I mean, right now, more African trade is Africa to the rest of the world than within Africa. So you can sort of imagine how bringing together just within the continent of Africa a continent-wide payments regime could be hugely important for economic development within the continent. So I think, and these countries are going to need technical assistance, and that's where I think the World Bank and the multilateral development banks can come in, and they also are going to need help. How are they doing? So I think that's where. And so I think there definitely is a role for the multilateral institutions in this process, and that's really why this was our second paper on multilateral reform.
Exactly. So on that note, Jerry, I will hand it back to you. We have 7 minutes, 6 minutes left.
Yeah, thanks very much, Siddharth and Bill. I'm sitting here thinking this is just a masterclass in this particular topic. I think anyone who's following this topic, or even anyone who feels they don't know enough about this topic, this would be a great place to start with the conversation you've just had. So we will make sure this video conversation is available on the website of the Bretton Woods Committee, on the website of the International Finance Forum, so that people can take advantage of it at their leisure at a later date. But this has been a masterclass in the topic. As I say, there was already very strong interest from media. And thank you, Siddharth, for so elegantly weaving in all those questions that were received from global media. And thanks to you, Bill, for taking them. We have 5 minutes left and we will finish on time. But we do have, I think, one question at least from one of the participants joining us today, from John Lin. John Hai, would you like to come in and ask your question live in person? And we'll ask Bill and Siddharth to respond and get us out of here in 5 minutes' time. John Hai?
Thank you very much, Jerry. Sure, just like you, I really, really enjoy the discussion, the conversation Bill and Siddharth have. Thank you so much, all of you, three of you, for presenting this truly important but very complicated topic. This is a very timely discussion. I only have two brief questions. First one, in developing national instant payment systems, how can the official sector leverage private sector payment systems technology in their market penetration? So how can we do that, therefore, to promote national payment system? Second question, what are the next steps to promote your very important and timely work? Thank you very much.
So the first question was about how you could leverage the private sector, and I think that's really important. That the private sector has to be included in the conversation in a substantive way, and I think there's a number of ways that can be advanced. The first thing I think is that the central entities that oversee national payments systems need to have deeper conversations with the private sector, and that means setting up advisory committees and having more conversations with the private sector. So it's the private sector. The private sector needs to have a seat at the table so they can sort of contribute to the conversation about what's feasible and why and what needs to happen. So I think that's really important. And the second reason I think the private sector needs to be involved is I think a lot of the government community in many regimes doesn't have the same level of technological expertise as the private sector. It isn't really right on the cutting edge of where technology is. And so it's also important to have those conversations and actually maybe even rotate some people in from the private sector into the public sector to sort of provide some of that knowledge and information. One thing I do worry about is that central banks just don't have sufficient expertise on the technology side to know what's truly feasible. And I think the private sector, there's lots of things going on, in the decentralized finance community, for example, that are looking at all these types of technologies, tokenization, stable coins. And I think it's really important that the public sector have a really good window into that kind of activity. In terms of next steps, I wasn't clear if the question was about what the Bretton Woods Committee is going to do. Obviously, we're going to continue to emphasize the importance of our work. Our thesis is very simple. We think international cooperation and coordination leads to better outcomes when you're talking about global public goods than individual countries trying to do things on their own. And so we think that for areas like climate, for cross-border payments, for biodiversity, a lot of different issues that can't be solved by individual countries acting on their own. And so I think this is where multilateral institutions, their role becomes very, very important. And it's important that national governments lean into that effort and understand that working together, we could get to better outcomes than if people just go their own way. Siddharth, you might have some thoughts on that as well.
Yeah, so I was going to suggest on the first one that probably there's one sentence that to me sums it up, that regulation and innovation cannot collide. And it needs to be done in a manner that the private sector is able to innovate at will, but settle transactions in a way that is done within the regulatory system. And in India, the route they've taken is that Google Pay, WhatsApp Pay, Phone Pay are the dominant payment providers, but they operate through regulated banks on the payments rail. So there is absolutely the products for the private sector, the way they interact with them, it's completely open, and the regulated sector has APIs that allow others to join in, and it settles within the central bank. And I think, at least what I've read from WhatsApp Pay and Google Pay, is that they're quite happy with someone running the system and getting closure, finality of payments, and them being able to innovate on the consumer-facing front. And that's probably one model. It's not a unique model, but one model that Shanghai may be operational in other regimes also.
I agree with that.
Good. Well,
Thank you very much.
Thank you. Thanks for the question, John Hai. Thanks for the answers, Bill and Siddharth. There's actually a very nice comment from Nan Song in the chat that we can look at, but she really just saying thanks so much and really love these talks. So I think that's a very fitting note on which to end. I want to thank the International Finance Forum. I want to thank the Bretton Woods Committee. Above all, I want to thank, on behalf of all of us, Bill Dudley and Siddharth Tiwari for giving us, again, this masterclass on a very important topic, a complex topic, but the way you have talked about it has brought it down to earth for us and made it very understandable. So thanks again to you. Thanks to all who've joined us today. Look out for that paper from Bill Dudley on cross-border payments. It's on the homepage of the Bretton Woods Committee website. And with that, let me say, have a great day, everyone, wherever you are. And we'll see you the next time for one of these discussions. Thanks again, and bye-bye.
Thank you so much.
Thank you.
Thank
Bye.
you. Thank you. Thank you.